Welcome back to Smart Stock Sam, the channel where we cut through the noise and get straight to what matters for your portfolio. And today, we are diving into one of the most talked about, most debated, and most explosive stocks in the entire market right now, SoFi Technologies. Before we go any further, here is what we are covering today. The massive bullish catalysts that are sending this stock higher, the terrifying short seller allegations trying to tear it down, the exact financial numbers you need to know, and the one single date that could change everything. If you have ever wondered whether SoFi is the future of American banking or just an overvalued app waiting to implode, stay with me, because by the end of this video, you are going to have a very clear picture. Now let me ask you something. What are the odds that a company posts record-breaking revenue, achieves full-year profitability for the very first time, builds one of the fastest-growing deposit franchises in the country, and still gets compared to Enron? Pretty low, right? Well, that is exactly where we are with SoFi Technologies this week. And that contradiction right there is why this stock has become the ultimate battleground on Wall Street. As of this week, SoFi is trading at $18.79, fresh off a jaw-dropping 15% surge in just 7 days. On the surface, the engine is absolutely humming. They crossed the $1 billion quarterly revenue threshold for the first time in company history. They delivered full-year GAAP profitability for 2024, real earnings, not adjusted fairy tale numbers, and they have built a $37.5 billion deposit franchise, which is the pure lifeblood of any serious bank. But here is the catch. Even with this massive recent rally, the stock is still sitting nearly 30 to 40% below its recent highs of $32.73. Major Wall Street institutions are slashing their price targets, and a looming short seller report is threatening to blow up the entire narrative. Everything is heading toward a critical showdown on April 29th. That is the date that decides who wins this war. Now look at this chart. And what you are seeing here tells a story of absolutely brutal volatility. We had a sharp, painful correction from those late 2025 peaks, a sell-off that wiped out billions in market capitalization in a matter of months. However, the April rally we are watching right now is not just random noise. It is being driven by a broader fintech recovery, supported by strong first-quarter earnings from legacy giants like Bank of America and Morgan Stanley. Proof that the American consumer is still alive, still spending, still borrowing. SoFi is riding that wave hard, but volatility cuts both ways. While a 15% weekly surge looks like a real breakout, the stock is still fighting to reclaim the highs from last year, and that tension is what makes the next few weeks so critical. So what is actually splitting the investing world right down the middle on this stock? On one side, you have the bulls. They see record financials, powerful new product launches including FedNow integration, and market mechanics like aggressive short covering that suggest the bottom is very much in. On the other side, the bears are screaming about an extreme valuation. We are talking 47 times earnings, and there are serious documented allegations of accounting fraud coming from one of the most feared short sellers on the planet, Muddy Waters. Big institutional banks are in full retreat, cutting their price targets even as retail investors pile in at record pace. It is a classic David versus Goliath setup, except in this version, David is armed with a high-growth fintech super app, and Goliath has an entire short-selling research operation hunting for cracks in the foundation. If we dig into the actual numbers, though, the bull case starts to look genuinely compelling. Look at this revenue growth. It is a pure hockey stick. SoFi did not just touch the $1 billion quarterly threshold, they powered through it with a 37 to 39% year-over-year jump. And for everyone who spent years saying SoFi would never be a real profitable company, they delivered $174 million in net income for the full year. They beat analyst estimates with a fourth-quarter earnings per share of 13 cents. These are not adjusted numbers designed to flatter management. These are hard, audited, GAAP-certified figures showing a company that has finally cracked the code on turning a massive user base into a massive bottom line. But revenue alone only tells part of the story. You also need to understand where that money is coming from. SoFi is no longer just a student loan refinancing company. Their lending business is still solid, growing at 15% year over year. But the real headline is the financial services segment, which exploded by a staggering 78% year over year and is now carrying a 51% contribution margin. Think about that, software-level profitability inside a bank. Meanwhile, their technology platform, powered by Galileo and Technisys, is now effectively the Amazon Web Services of fintech, enabling transactions and accounts for up to 158 million accounts worldwide. This is a genuinely diversified business, and that diversification is building a structural advantage that their competitors simply cannot replicate overnight. And that structural advantage is powered by what CEO Anthony Noto calls the flywheel. And honestly, once you see it, it is hard to unsee it. It starts with member acquisition. SoFi has grown to 13.7 million members in just 3 years. Once those members are inside the ecosystem, they do not just use one product, they adopt multiple products, leading to a 40% cross-buy rate across the platform. More products mean more deposits, which have now surged to $37.5 billion. Why does that matter so much? Because deposits are cheap capital. Instead of SoFi going to the bond markets to borrow money at high rates so they can lend it out, they use your deposits at a fraction of that cost, creating a permanent structural cost advantage that pumps profit right back into the growth machine. It is a self-reinforcing loop, and it is genuinely difficult to stop once it reaches critical mass. And they are pouring even more fuel on this fire with 2 massive product catalysts that almost nobody is talking about enough. First, SoFi is now one of the very first banks in the country to fully integrate with the Federal Reserve's FedNow service, allowing their members to send and receive instant payments 24 hours a day, 7 days a week. Most regional banks can only receive these payments. SoFi can both send and receive, giving them a clear competitive edge in the race for real-time money movement. But potentially even bigger than that is the launch of SoFi Big Business Banking, an enterprise-level platform that handles both traditional fiat and crypto transactions inside one fully regulated system, including their own stablecoin called SoFi USD. They have already signed up heavyweights, including MasterCard and BitGo. They are not just taking on regional banks anymore. They are going straight at the biggest players in financial services. Now, none of this matters if we do not honestly confront the dark cloud hanging over this company. Enter Carson Block and Muddy Waters Research. They have released a serious bombshell report alleging that SoFi is essentially built on financial engineering. The core claim is that SoFi is using questionable accounting methods to inflate their adjusted EBITDA by a remarkable 90%. Block went even further, drawing direct comparisons to Enron and alleging that the company is hiding $312 million in unrecorded debt obligations. SoFi's management has pushed back hard, calling the report a fundamental misunderstanding of their business model and reportedly exploring legal action. But in the world of finance, a fraud allegation like this, regardless of whether it is ultimately proven, creates what I call a trust tax that the stock has to pay until the truth becomes undeniable. And that trust tax is expensive. That trust tax becomes even more painful when you look at the valuation cold and sober. SoFi is currently trading at 47 times earnings. Compare that to traditional digital adjacent lenders like Ally Financial at 7.6 times or Synchrony Financial at 8.8 times earnings. SoFi is trading at a 600% premium to its peer group. That means the market has priced in flawless, perfect, nothing goes wrong execution. There is zero margin for error heading into these next earnings. Miss a single key metric, and that 47 times multiple could compress with brutal, violent speed. And the big institutional banks seem to understand exactly that. Barclays slashed their target from $28 all the way down to $18. Goldman Sachs cut their target to $20. Wells Fargo is sitting at $18. And just recently, Argus Research initiated coverage with a cautious hold rating. These analysts are citing a defensive repositioning in the face of macroeconomic headwinds and that dangerously stretched valuation. When the so-called smart money is cutting targets while retail investors are piling in, that kind of divergence is historically very dangerous territory. But here is where it gets genuinely interesting. Look under the hood at the actual market mechanics, and a very different picture starts to emerge. While the Wall Street analysts are bearish, the options market is flat out on fire. We saw a 53% surge in call option volume on April 15th. That is aggressive, conviction-driven, bullish betting by sophisticated traders heading directly into earnings. At the same time, short interest is sitting at 13.3% of the float, which means approximately 167 million shares are currently short. If SoFi delivers a strong beat on April 29th, every single one of those short sellers will be forced to cover their positions, and that could trigger a massive explosive short squeeze. And let us not overlook the Noto factor. CEO Anthony Noto used $1.5 million of his own money to buy personal shares in March. That is not a man who thinks his company is in trouble. Technically, the stock is in what I call a repair phase. It is trading above its 50-day moving average of $18.10, which confirms short-term bullish momentum and puts it in a strong buy posture on the daily chart. However, there is a major warning signal you cannot ignore. The 14-day RSI is sitting at 80.8. That means this stock is strictly overbought right now. We are hitting resistance right around the $19.50 level, and a short-term pullback to the support zone between $17.80 and $18.50 would be completely normal and healthy before any next leg higher. And that brings us to the moment that everything has been building toward. April 29th. Mark it in red on your calendar right now. Management has set a high bar for themselves, $1.04 billion in revenue and 12 cents in earnings per share. But this earnings call is about far more than just the numbers. SoFi must deliver a clear, detailed, legally credible rebuttal to the Muddy Waters fraud allegations. They must prove to the institutional world that the flywheel is real, sustainable, and built for a high interest rate environment with genuine macroeconomic headwinds. If they miss, if they stumble, if they fail to address the accounting questions head-on, the Enron narrative wins the day. But if they beat, if they crush those numbers and come out swinging against the short sellers, the future of banking narrative comes roaring back. And this stock could move in a very big way, very fast. Now, before I give you my final take, I need to be very clear about something important. Nothing in this video is financial advice. I am not a licensed financial advisor, and everything discussed here is purely for educational and informational purposes only. SoFi Technologies is a highly speculative stock with significant risks, including short seller allegations, regulatory exposure, and a premium valuation that could compress rapidly. Always do your own due diligence and speak with a qualified financial professional before making any investment decisions. Past performance is never a guarantee of future results. With that said, here is the bottom line. SoFi's operational engine is undeniably strong. The financial results are real. The flywheel is building momentum. But the valuation is historically expensive. The short seller allegations are serious until proven otherwise, and the macro environment is genuinely uncertain. April 29th is the resolution event. It will either trigger a massive short squeeze that validates the entire digital banking thesis, or this stock will capitulate hard to the bears if guidance disappoints. If you are in this trade, you are operating in a war zone. Watch the $18.50 support level like a hawk. Watch the April 29th earnings numbers with laser focus. And please, for the love of your portfolio, manage your risk. Now I want to hear from you. And this is a genuinely important question I think about a lot. If SoFi completely crushes earnings on April 29th and fully rebuts the Muddy Waters allegations, does that make them the most credible challenger to traditional big banking that we have ever seen? Or is a 47 times earnings multiple simply never justifiable for any bank, no matter how good the story? Drop your answer in the comments right now. I read every single one and reply to as many as I can. If this video helped you think more clearly about SoFi or the fintech space, do me one small favor and hit that like button. It takes 2 seconds, and it genuinely helps this channel reach more investors who need this kind of analysis. And if you are not subscribed yet, hit that subscribe button and turn on notifications so you never miss a breakdown like this one. If you really want to support Smart Stock Sam and help us keep producing deep, independent research like this, you can send a super thanks right here on YouTube. It means the absolute world to this channel and keeps us going. Until next time, stay sharp, stay disciplined, and I will see you in the next one.